In 2026, millions of Americans are doing exactly what they were told was responsible. They are saving money. They skip purchases, cut back, check the bank balance, and finally feel like adults because the number moved up. And to be clear, saving is not stupid. Emergency cash is not stupid. Being prepared is not stupid. But saving money the wrong way can quietly make you poorer every month, while the bank smiles politely. Not because cash is useless, because cash has a job. And most people give every dollar one job. Sit there. $1 can protect you. Another can attack debt. Another can buy skills. Another can compound in assets. But a dollar sitting in low yield forever, while inflation rises and credit card debt grows, is losing the fight. Most people were taught one simple rule: save as much as you can. That advice came from an older economy. But the 2026 economy is heavier. Rent, insurance, debt, food, healthcare, and the cost of breathing normally. The old advice is not evil. It is just too small for the new game Americans are playing. This video is not telling you to spend everything. That is how people become broke with nicer shoes. This is about smart cash versus dead cash. One buys options. The other gets quietly eaten. Dead cash feels safe until prices, debt, and opportunity cost start chewing through its purchasing power. So the question is not, should you save money? The question is, after saving it, what is the money doing? Cash can save you from an emergency, but cash alone will not save you from the system. Let's start with the part everybody still needs. Emergency cash. Not vibes. Not motivational quotes. Cash. Car repair. Rent jump. Cut hours. Medical bill. Dental pain. One bad email from work. Life does not ask permission. When that happens, you need money that can move immediately. Emergency cash should not need courage to withdraw. Federal Reserve data showed only 63% of US adults could cover a $400 emergency with cash or its equivalent. That means millions are still one small shock away from panic. So yes, build the emergency fund. But here is where the script changes. The emergency fund is not the finish line. It is the floor. Once you have cash, the next question is not, how do I save forever? It is, where should each layer live? Layer 1 is instant cash. Money for rent, food, car repair, medical deductibles, job loss, and urgent travel. This money should be liquid, boring, and easy to access. Checking for bills. Savings for emergencies. Not crypto. Not meme stocks. Not your cousin's business idea with a logo made in 12 minutes. Layer 2 is better yield cash. Still save money, but it should not be sleeping because your bank has a nice logo. Fred and FDIC showed the national savings rate was 0.3 to 8% in May 2026. If one insured account pays meaningfully more than another, ask the obvious question: why is your money taking a nap? Layer 3 is mission cash. Money waiting for taxes, equipment, education, a down payment, or scheduled investing. Without a purpose, cash becomes dead cash. Next, let's map exactly where beginners can put it. Now, let's make this practical. When people hear high yield account, many beginners have no idea what that actually means. A high yield savings account, or HSA, is usually an online savings account that pays more than a traditional big bank savings account. For normal savers, the keywords are insured bank or insured credit union. Safety matters before chasing a flashy APY. Check insurance coverage, fees, minimum balance, transfer speed, withdrawal rules, and whether the rate is promotional. A high APY means nothing if the account is hard to access, full of fees, or wrong for your emergency life. Next, money market accounts. These are bank deposit accounts that may offer savings-like safety with more flexibility. A HISA may be simple. A money market account may be more flexible. The better choice depends on access, fees, and your habits. Next, certificates of deposit, or CDs. You lock money for a fixed term, and the bank pays a fixed rate. CDs can work for money you do not need immediately, but do not lock your whole emergency fund behind penalties. Next, Treasury bills, or T-bills. They are short-term U.S. government securities, often used for conservative cash planning. A T-bill is commonly bought at a discount, then pays face value at maturity. The difference is the interest. T-bills can be useful, but they are less plug-and-play than a savings account. Understand auctions, maturity, access, and taxes. Now, important, money market funds are not the same as money market bank accounts. One is an investment fund. Money market funds usually hold short-term debt, cash, and cash equivalents. They may be low risk, but they are not magic. The goal is not chasing the highest number online. The goal is matching each dollar to the right job. Next, inflation. Now let's talk about the silent tax on lazy cash. Inflation. It does not steal your dollars. It weakens them. Most people check the bank account and think in dollars, but the economy thinks in purchasing power. $10,000 can still say 10,000 on the screen, while buying less rent, food, gas, and healthcare. That is why a low-yield account can feel safe while quietly making your future smaller. BLS reported CPI-U rose 0.5% in May 2026, after rising 0.6% in April. Over the last 12 months, the All Items Index increased 4.2% before seasonal adjustment. Energy rose sharply in May. Shelter and food kept moving too. That is how small monthly changes become household pressure. Meanwhile, Fed and FDIC showed the national savings rate was only 0.3 to 8% in June 2026. When cash earns 0.3 to 8% and prices rise much faster, the balance can grow while strength falls. That is the cruel part. The saver feels responsible, but rent, food, insurance, and repairs keep outrunning the account. A high-yield account helps, but remember, it is a better parking spot. It is not the whole highway. Emergency cash protects. Long-term money must eventually grow, build skills, buy assets, or create productive capacity. This is how responsible people stay stuck. They avoid reckless spending, avoid debt, build cash, and then stop. The trap is not saving. The trap is stopping at saving and never letting money become productive. But inflation is only one enemy. Next comes the trap that can destroy savings even faster: expensive debt. Now, we need to talk about the trap that can destroy savings faster than inflation: expensive debt. Emotionally, money in savings feels safe. You look at the balance and think, finally, I am responsible. But if savings earns a tiny rate, while credit card debt charges a brutal rate, your money is crawling while debt is sprinting. A savings rate may whisper. A credit card APR can shout. That gap is where fake progress gets exposed. Federal Reserve G19 showed consumer credit rose at a 4.8% annual rate in April 2026. The dangerous part was revolving credit. It jumped at a 10.4% annual rate. By April, revolving consumer credit stood near $1.3 to $5 trillion. That is not a small side problem. Fed data showed credit card plans around 21% APR in early 2026. That is expensive gravity. This is why $1,000 saved can feel powerful, while $7,000 of card debt quietly owns the room. The system loves this setup. Your cash earns little, your debt charges much, and you feel safe while net worth bleeds. A stronger question is not, how much do I have saved? It is, what is my net position? One mistake is hoarding comfort cash while toxic debt grows. The opposite mistake is paying debt and leaving no buffer. The smarter approach is layered. Keep a starter buffer, stop new debt, attack high interest, improve cash yield, then rebuild. Saving is supposed to increase freedom. High interest debt does the opposite. It is a leash with a monthly statement. Once the financial fire is under control, the next move is the one most savers miss. Save, then convert. So, what is the solution? Do not stop saving. Stop saving blindly. In 2026, money needs a ladder. Safety, debt attack, better cash, growth, assets, and ownership. Step 1. Build starter emergency cash, so life stops pushing every surprise onto a credit card. Step 2. Put emergency cash somewhere safe, liquid, insured when possible, and yield aware. Step 3. Destroy toxic debt, especially the debt growing faster than your savings can breathe. Step 4. Build the full emergency fund based on your real life, not a random rule from a stranger online. A single renter, a parent, a contractor, and a homeowner do not need the exact same cash buffer. Step 5. Convert extra cash into growth skills, investing, business tools, income systems, and ownership. Saving says, do not lose. Wealth says, learn how to win. A dollar can defend, attack debt, buy a skill, buy tools, buy assets, build a business, become ownership. The question is not simply, should I save or invest? The question is, What should this dollar become next? No emergency fund? Safety? Toxic debt? Weapon? Stable cash? Seed? Existing assets? Allocation? Cash is not the destination. Cash is the airbag, the runway, the shield, and the waiting fuel. You save to survive. You invest to grow. You own to escape. Saving money in 2026 makes you poor only if you mistake the bridge for the destination. Do not worship the bridge. Cross it.